Hey, it's Jim, and this is level 3 of the CFA program, the topic on fixed income portfolio management and the reading on yield curve strategies. Let me just quickly remind you about the yield curve. It's nothing more than an illustration of the relationship between time to maturity on the horizontal axis and yield to maturity on the vertical axis. And remember that in developing and developed economies and expectations of an expanding economy, yield curves are almost always upward sloping, although they can be flat, and of course they can be downward sloping. So what we're going to do in this reading, what the Institute emphasizes, is our fixed income portfolio. How are we going to manage it when the yield curve changes? Of course, we know that definition of the yield to maturity on a bond is simply the required return. And we know required returns, they change all the time. Remember back in level 1, we had that conversation where the interest rate or the yield on a bond was a function of a couple of different factors. Remember we had the real risk-free rate of interest, and we added a liquidity premium and a default risk premium and a maturity risk premium and maybe some other premiums in there. So we know that those little inputs, those are going to change all the time. So the yield curve is going to change. So we need to have a strategy to adjust our fixed income portfolio to reflect the changes in the yield curve. Now, this is a reading on yield curve strategies. The next reading is going to be on default risk and strategies in managing credit and default risk. But our focus here is on the yield curve. And so notice these action words. They're all formulate, 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 all the way down to the bottom. Now, the first LOS I'll show you here in just a second, and this is something that we've done before. But then we're going to have to formulate a portfolio positioning strategy. And when you look at the problems at the end of this reading, you are oftentimes given, a bunch of bonds in a table, and then you'll identify maybe a barbell portfolio and a bullet portfolio, maybe an equal weighted portfolio. And then those will be your 3 answers in a multiple choice format. Which of the following portfolio does this or it does that. So we're going to address that formulate LOS in multiple scenarios and multiple slides as we go through. Then look at the very bottom. We'll go ahead and have another conversation on how currencies impact these factors, and then we'll have an example at the very end. So let's go ahead and start, like we do many, many times, with a brief recap. Now, the reading goes to great lengths to distinguish between passive management and active management. And of course, the focus is probably on that active management. And what's the goal? Just to outperform a benchmark. Let me go ahead and just remind you that we're not just outperforming any benchmark, we're outperforming a specific benchmark that we, as good financial analysts, identify at the beginning of the investment process. So remember that benchmark selection goes somewhere in the policy statement so that at the end of the period, let's say at the end of the year, we know exactly which benchmark against which we are comparing our performance. So the goal then is to find these extra returns. Remember the academics call these excess returns or abnormal returns even sometimes. And we're going to do this with primary risk factors. And this is exactly what we talked about in equity risk factors, where we had things like maybe inflation or exchange rates. But here we have primary yield curve risk factors, and we did this back in level 1. We have the changes in the level of the yield curve, which is always referred to as a parallel shift. Changes in the slope, which means that the curve becomes steeper or flatter. And then changes in shape or curvature. Those are called structural changes or twists. Now here's a good slide to memorize, but this is similar to what we've done in the CFA program previously. We're also going to have this in a much, much later slide. So we'll look at this one 2 times here. So what are we doing? We invest in a fixed income portfolio for 2 reasons, right? What are those 2 reasons? For income, right? So we'll use that income at the very top, and then a capital gain. And so what do these capital gains come from? Well, they come from the roll down return. That's the simple fact that bonds that sell at discounts see their prices rise over time as we get closer and closer to the maturity date. Bonds that sell for premiums will see their prices decline over time as, once again, we get closer and closer to that maturity date. So that's just the simple roll down return. And then we need to add our expectations due to 3 unique factors. We need to compare it to the benchmark yield. We need to compare it to just general yield spreads. And let me just remind you that we've talked about a variety of different kinds of spreads. But in the general context of spread analysis, I think it's fair just to say something like, all right, we take some kind of regular old risk-free government bond, and what does our bond look like? What does our yield on our bond look like? Or our bond portfolio? That's probably the spread that we're looking at. And then, of course, we'll go ahead and add an expectation for currency value changes, which, of course, will be 0 if we're a U.S. investor investing in U.S. bonds. That'll only play a role if we add international bonds to our portfolio. That should make perfect sense. So here are a couple of equations that summarize what we did just in that previous slide. Look at the very top, annual amount of the coupon divided by the current price of the bond. That gives you what's known as the current yield on the bond, and then the roll down return. That's just really a simple F over P minus 1. Notice this is important in there, assuming a constant yield curve. So that roll down return, and what I was saying earlier about the discount and the bond selling at a premium, if the yield stays the same, then bonds that sell for a discount will experience a capital gain. Bonds that sell at a premium will experience a capital loss. And then these final 2, these are really super cool because we're going to use convexity and duration to help us come up with that expected return. And so we've seen this formula before. We've seen this back in level 2. All we're going to do is take our duration, and this will be the modified duration times the change in yield. There's the delta sign there, the change in yield. And then we're going to add the convexity adjustment. Remember, on the right-hand side of that plus sign, that's called a convexity adjustment. We're going to take 1/2 of convexity times the change in yield squared. Now remember, duration is a first derivative. Convexity is a second derivative of the price-yield relationship, and that's why you have a squared there over on change in yield, and that's why you have a 1/2 there. That's the result of calculus. Nothing for you to worry about. And then if you skip down to the red, we do the exact same thing for yield spreads. Instead of change in yield, now we have the change in yield spreads. Instead of change in yield squared, we have change in yield spread squared. So if you go ahead and combine all those things, you're going to get, let me just go back here. You're going to get the expected fixed income portfolio return. And then we'll add currency in one of the last slides. Now I want you to think about this yield curve, and let's just suppose that it's upward sloping and we go from, let's say a 1-month security all the way out to, well, we could go out to 50 or 100 years even. And let's suppose it's just an upward sloping yield curve. And so how do we model that yield curve? Well, we need to take a look at exactly what's available to us. I mean, think about a universe where the government is, by congressional law, is only allowed to issue 1 and 27 and 54-year bonds. So you got all these bonds at those 3 different levels. Well, what if you have a 10-year or a 12-year investment horizon? How do you deal with all of that? So there's lack of uniformity. There are maturity gaps, and there are inconsistencies based on just the kind of general ideas behind these issuing companies, and in the example that I just gave, the issuing governments. And so what do you have to do? You have to try to reach into the bucket of available bonds that are trading out there in the secondary market and kind of pull some of those out to form a uniform or a smooth yield curve. And so notice we have that word interpolation in there. We can do extrapolation. We could probably do some other kinds of olations. But essentially what we're trying to do is just fill in the gaps because there's not a bond issued at every time period for every level of not just default risk, but all those risks that we talked about at the beginning of this slide deck. Now, if we reach into that bucket of bonds, we could pick out any that are trading on the secondary market. But lots of times what we really like is we really like to use on-the-run bonds. These are those bonds that are the most recently issued, which means that when they came to the market, the entire bond portfolio was sold to the investing public. So that yield to maturity data and the subsequent duration and convexity calculations are reflected in massive amounts of data. As opposed to, I use this example regularly, 30 some years ago, Walt Disney issued a 100-year bond. Well, those bonds are still trading, but I bet 5 or 10 of those bonds trade hands today. So do you want to use that, or do you want to use the bonds that were issued by, pick another large company like Procter & Gamble's? Suppose it issued a 100-year bond today. You got all these bonds that are being issued today in the primary market that leads them into the secondary market. And so those yields to maturity then are more highly reflective. So that's why that fourth issue here in modeling the yield curve is so important, to use on-the-run bonds, and hopefully there are some out there. And then, of course, the Institute is keenly aware that there are differences in accounting treatments and tax treatments and regulatory treatments between and among all the different types of governments that are out there, not least of which here in the United States. We have these municipal bonds that are issued by 50 different states, and so there might be different accounting or tax or regulatory treatments for each individual state, not to mention every country in the entire world. All right, so let's go ahead and take a look at the primary yield curve risk factor. So let's start with just the level, and this is just a parallel shift upward and downward. There's kind of a unique shaped yield curve right there. Most of the times in an upward slope, it looks a little bit different than that. But remember, the yield curve can take on almost any shape. The reading does go into some detail, and it references a particular study that shows that this parallel shift accounts for the overwhelming majority of the movement in the yield curve, around 82%. And there are other studies that are out there. I don't ever memorize 82%. I always remember around 80%, and then, I went ahead there and I wasn't meaning to do that. Around 80% for the level, and then around 15% for the slope, and around 5% for the shape. The reading gives you just a few different kinds of percentages in there. I don't have any idea how important that is for exam, but I think it's important to know that parallel shifts account for the overwhelming majority of changes in the yield curve. Now, how about the slope? This is just a flattening or a steepening, and so all we're doing is we're just making it either flatter or steeper. Now, what we can do is we can go ahead and try to infer something about the spreads associated with the steepening or a flattening of the yield curve. And so that's what we have in the boxes there on the left-hand side. Notice that a widening of the spread probably results in a steepening yield curve, and that's probably going to occur at the longer-term maturities, right? If that widens, well, then it's going to be steeper. And if it's going to become more flat or more narrow, then we probably have the opposite type of an event that occurs in the short term. Now, this final factor is the curvature, and one of the ways to measure this curvature is really interesting. It's called the butterfly spread, and there's a good picture of it there. So sometimes it can be humped, and sometimes it can be convex. And so just remember those two. Remember, the positive butterfly spread is humped, so there's some concavity in the middle. The negative butterfly spread is convexed, and that's kind of like the little smiley face there going down underneath the up and down arrow points. Now, the LOS asks us to describe, so go ahead and look at that last diamond point there. What we're going to do is we're going to just take a difference between short, middle, and long-term yields. So look at that equation. We're going to take the short-term yield, and we're going to take the long-term yield, and then in the middle, we're going to take 2 times, we're going to count the medium-term yield twice. And so we'll be able to determine whether that butterfly spread is either positive or negative. And so I'm guessing the questions are going to be something like, hey, here's the thing, here's the question stem, here's some data, what can you infer from this? And you'll say, oh, because of this and this. Maybe you'll have to use that equation, but I wouldn't guess that you would. You'll be able to say something like, oh, that's positive, there's concavity, or it's negative, there's convexity, which, of course, is going to lead us into our next LOSs. Remember, our next LOSs are all like formulate a strategy. So if you have a positive or a negative butterfly spread, you might be influenced by the shape of that spread in terms of which bonds that you might want to buy and which bonds that you might want to sell or avoid. All right, how can we put together some kind of a strategy considering the level and the slope and the twisting of those different parts of the yield curve? So we'll start with duration management. Remember duration, what did I say just a few minutes ago? It is a first derivative. And what it tells us is that we can decide based on the duration of the portfolio what the reaction to the price will be if the yield changes. We know that when yields go up, bond prices go down. And we know just the opposite holds true. Well, we're going to use duration. In fact, we're going to use modified duration to be able to come up with a precise model to estimate that new price. All right, so what are some strategies here? If we expect yields to rise for whatever reason, remember we talked about those reasons and those factors earlier. If we expect interest rates to rise, that means that the prices of our bonds in a portfolio are going to fall. So do we want to hold longer term bonds if we expect yields to rise? And the answer, of course, is no. So look at that first circle point. We want to shorten portfolio duration. And we can do that. A number of different ways. We can go ahead and just say, you know what? We don't really want our long-term bonds in our portfolio anymore. We can sell those. Well, I've said this before. That's really not a good choice because, after all, as good financial analysts, we've spent tons of time, tons of energy, and tons of resources picking these bonds for our clients. And if we expect interest rates to rise over a 1 or 2 or 3 year period, we don't want to throw all of our work just down the drain by selling those bonds and holding cash. Not least of which is because there might be tax implications, there are bid and ask spreads, there are adverse selection costs, there are all sorts of regulatory issues. So we like these bonds. So what's the easiest thing to do? I've said this to you 100 times, starting in level 1, level 2, and level 3, is to layer that ownership with a derivative security. So we can sell a bond futures contract. In other words, take the short position in a bond futures contract. And we've shown this back in level 2. It can be exactly matching if we actually went and sold our bonds. Now, of course, this occurs in the short term, and so we need to manage our futures positions, or we could do this in a forward contract, or we could do it in a swap contract. What we're going to do is enter a pay fixed interest rate swap. So we're paying the fixed rate, and what are we getting? We're receiving the floating rate, which we expect to be higher, right? Because we expect yields to rise. Now, do I need to do all that in reverse for the down arrow there? Lower expected interest rates. We want to increase the portfolio duration. So what's going to happen? If interest rates fall, all of our bonds are going to increase in value, but we know that those with longer maturities, those with longer durations are going to increase in value by way more than those shorter term bonds. So we can purchase longer term bonds. We can sell shorter. We don't want to do that. Why don't we go ahead and take the long position in a bond futures contract? Why don't we go ahead and enter a swap in which we receive the fixed interest rate and then we pay the floating rate, which of course is now lower. This is a beautiful slide. I talk about this in class all the time, both in my investments class and my derivatives class. Now remember that duration, and this is the third time I've said it in this recording, duration is the first derivative, which implies that there must be a second derivative. And so that second derivative is known as convexity. So think about this. There's convexity that looks like this. We like convexity, right? We want to have high convexity bonds, so we're willing to pay more for a high convexity bond because when interest rates fall, when the yield on the bond falls, then our bond price with a higher convexity is going to increase in value more than the increase in value of a bond with a lower convexity. And then just the opposite happens. When yields rise, our bond prices fall, but those bonds that have high convexities, they lose less value. So we want to buy convexity. We want to buy convexity if and only if we expect the yields to change. That's why we have that in that third embedded bullet point. So think about this. If the Institute gives you a question and says, hey, yield curve is flat, and a good financial analyst is expecting it to remain flat and to remain unchanged for the next 27 years. Formulate a strategy associated with this. Well, your strategy is just a yawn. There's no strategy that you can employ that is going to benefit because of high convexity. So you're only going to buy convexity when the yields are expected to change. Think of it this way. That convexity, it gives you an extra return when yields fall, and it minimizes, boy, do I really want to say that word? It kind of lessens, it minimizes the loss, the capital loss, when interest rates rise, as compared, of course, to bonds with lower convexity. So remember, convexity is good, and hopefully you remember all this from level 2. Now, how can we increase convexity by not just buying bonds that have lots of convexity? And by the way, there are several really, really cool web pages where all you have to do is type in the maturity date, coupon rate, and yield to maturity on a bond, and you get duration and you get convexity. I have my students do this all the time, and I have them go out and find those bonds that have the duration that matches the investment horizon of their clients, and then find the bonds that have lots of convexity. These are just super fun exercises for my undergraduate students. But how else can we do this? Well, we can layer this with derivatives, right? We can buy a call option on a bond, or we can buy a put option on the bond, depending on whether we expect interest rates to go up or down. And what we can do is make the structure of those coupon payments more of a barbell shape, increase the distribution of those cash flows. All right, so there's a picture of the bullet portfolio down there, time to maturity. You just, buy those bonds at each time to maturity. And then the barbell strategy, of course, is, the barbell. So think of the Olympics where, they're really, really strong men and women. They bend over and they go like this and have no idea how their spines don't break, their knees don't collapse, their ankles aren't crushed. I guess that's what lots of training and having lots of muscles does for you. Now look at the bottom two bullet points. This is important here. Higher convexity relative to the bullet from here. Let me go back here. Higher convexity. This has low convexity. This has high convexity, and this does well when the yield curve flattens, either from an upward or a downward sloping yield curve. It flattens. Now let's go back to that example of what I just said about. Let's suppose that we have a static yield curve, so we're not really thinking that the yield curve is going to change. So what we're going to do is we're going to buy and hold. This is appropriate when the curve is upward sloping. And what that means is that we're probably going to buy some bonds that have a duration that are greater than the benchmark. Buy and hold means that we don't have to have any active trading. And this buy and hold strategy probably results in a higher expected return. Now, we may want to roll down or ride the yield curve for an upward sloping yield curve. What do we know? That as we get closer and closer to the yield to maturity, the bond yield will decline. And that must mean that the price goes up. So there's our capital gain. Time passes and the yield decreases. There's the higher price appreciation that I was talking about. Now, how about if we want to sell convexity? High convexity implies lower yields in the event of a static yield curve. This is what I just said, right, a few moments ago. Convexity of is no value. It is not expected to change. So you might want to sell that convexity. You can write call options. You can write put options because then you'll collect that premium, and that premium will go ahead to offset this static yield curve. And then, of course, you can go ahead and take advantage of this by buying callable bonds or those mortgage-backed securities. And what will happen then is that if the interest, remember, you're thinking that the yield curve is going to stay at its current shape and its current level, and so interest rates are not going to fall, so the bond is not going to be called. The mortgage-backed securities are not going to have any of those mortgages refinanced, so you don't have to worry about falling interest rates, so that you get, I always tell my students, you kind of get cheated out of the option-free bond price with owning a callable bond. Now, of course, you can do these carry trades. This is leverage, and so all you're going to do is finance the purchase of a high-yield security by selling a lower-yield security. So you may have to do a margin. You may have to short sell. You might have to do something else. I mean, whatever you do, don't recommend using the equity in a home to finance a higher-yielding bond. Don't do that. Don't risk being kicked out of your house for a high leverage strategy, right? Securities can have the same or different currencies. Again, we'll face that at the end of this slide deck. And so what we're trying to do with this carry trade is to earn the spread between those two yields. All right, how else can we do this? We can do this by layering a derivative. And so this is what I was saying earlier. We can take the long position in a futures contract. This is similar to rolling down the yield curve. And so all we're doing is we're saying, all right, let's take the long position, which means we're agreeing to buy, let's say a treasury bond at some point. And we can do this for a month and then another month and another month and another month. And what are we doing? We're trying to take advantage of the simple fact that those yields, as we get closer and closer to the maturity date of that underlying treasury bond, that the price will move towards $1,000 in its par value. Now look at that second bullet point there. This is important. Remember, when we're in the derivatives market, we don't get any cash flow. So this relies purely on price appreciation and not on any kind of coupon income. Remember, with futures contracts, we don't have to put up any capital initially, but we do have to post a margin and maintain a margin. And so essentially what's happening here is that you can either increase duration like we're doing here in the long position in the futures contract. I mean, you can decrease duration by taking the short position, through this margin and daily market to market valuation. So this is, one of those synthetically replicating positions. Now we can also do this with a receive fixed swap. There's our formula. I think we've seen that before, the targeted return. All we're going to do is we're going to receive the fixed swap rate, and we're going to pay some kind of a market reference rate. I mean, it could be the old days, it would be LIBOR. Now it's probably SOFR. And I mean, it could be almost any market reference rate. I think the Institute is probably going to use that term, market reference rate, rather than LIBOR or SOFR, mostly because it's the Institute's reaction to the scandal with LIBOR, and so they don't want to be tied into, any kind of an actual real interest rate. So look for the term market reference rate in there. And so what's happening is that when we receive this fixed leg, that's going to increase the portfolio duration. So back up to the LOS, if we're formulating a portfolio positioning strategy and we want to increase the portfolio duration, then we're going to enter a receive fixed rate and pay the floating rate. And there's that target return down at the bottom. I'm not quite sure that you would have to calculate that, but that's probably a good formula. Another one to memorize. I mean, you have to memorize 1,000 of them, so you might as well memorize 1,001 of them. Now, how about a dynamic yield curve where we're going to have an upward or a downward or some kind of a twist? Well, what are we going to do if we anticipate a yield curve change? So this is why the Institute has us as good candidates. Back in level 1, we did multiple readings on micro and macro economic analysis. Level 2, we did the same thing. Level 3, we did the same thing. So we need to understand the macro economy. This is why I tell my students all the time, it's so important to read the Wall Street Journal every day. I bet you've heard me say this before. So what are some requirements here? And this is right from the reading. Understanding the performance of the benchmark, understanding the client-imposed constraints and the current portfolio characteristics. So think about this. Those 2 and 3, those are unique to the client, which we get from our interviewing the client and crafting the policy statement. But before we can complete it, we need to make sure we understand what is the relevant benchmark. I said this earlier, identifying that benchmark and then understanding its yield curve and how it's going to change. So that leads us down to the purple box, having a well-articulated yield curve forecast. So we can look in the Wall Street Journal and we can see a picture every day of the yield curve, and then we can say, okay, a year from now, what is it going to look like? Well, we cannot create a well-articulated yield curve forecast unless, are you ready for this? Unless we know everything there is to know from level 1, level 2, and level 3. And then finally, the blue box is exactly what this portfolio positioning strategy is going to tell us. So let's go ahead and talk about a couple of these things. If the investor anticipates a parallel upward shift in the yield curve, what does that mean? That means that rates are going to rise. Every bond in our portfolio is going to drop in value. So we want to lower the duration of the portfolio. How do we do this? Well, we've just been through this, right? Let's start over on the right-hand side. We short the futures contract. We can pay the fixed rate in a swap, or we can do some short selling over on the left-hand side. Now, what happens if we expect an upward shift in the yield curve, but it's not going to be parallel. It's going to be unparalleled. Is that a word? Non-parallel. Wow, maybe the short-term rates go up by 50 basis points and the long-term rates go up by 100 basis points, whatever that is. So in order to take advantage of this, what's the LOS? Formulate a positioning strategy. We need to take a combined position. Right? Combined position. We're going to do stuff in the short term and we're going to do stuff in the long term to take advantage of those. Now, look at the very bottom part of that sentence. A greater dispersion of cash flows. That's our goal. Now, I want to go through these next two slides here. So we have bear steepening and bull steepening, and then we have bear flattening and bull flattening. And so these are exactly what you might suggest and you might think about just our general idea about steepening and flattening and bulls and bears. But I think, we have a lot of bullet points here, and I think those are really, really good. But what's best about this particular slide is the curve over on the gray box over there. So bull flattening, what do we have? We got this upward sloping yield curve, so we're getting flatter, but what happens? Longer term yields are falling by greater amounts than the short-term yields. So we call this bull flattening because yields fall, all of our bond prices go up, but the longer duration bonds increase by more. All right. Same thing with bull steepening, except we're just gonna reverse this. We've got this curve, and now the rates fall, so now the curve becomes steeper, which means that the shorter term bonds are going to increase more in value than the longer term bonds, just because of that difference in the change in yields. And then you can figure out bear flattening and bull steepening. And what I'm going to ask you to do right now is to go ahead and get out your phones and take a picture of this slide. Did you do that? Click. Any of you guys read Cam Jansen when you were younger? I used to read that to my daughter all the time. Bear flattener. So go ahead and take a picture of this one. Click. And I'll go ahead and just alert you that when you look at the problems at the end of this reading, there are a couple of really, really cool questions about these 4 different scenarios. And if you have those pictures embedded in your brain like Cam Jansen used to, I think you can answer those questions. All right, how about a change in curvature? This takes us back to that butterfly strategy. Remember, we had the hump or we had the smile. There's our butterfly spread equation. We did all that before. And so what we're going to do is we're going to call this a butterfly strategy. We're going to combine long and short positions in bullets and barbells to make a profit. All right, so you ready to go through this? If we think the butterfly spread is going to increase, that must mean that the midterm rates are increasing way more relative to short and long-term rates. So what are we going to do? We're going to short sell a medium-term bullet, and we're going to take the long position in the barbell. And so that's the butterfly. There's the body in the middle and then the wings. If we expect the butterfly spread to fall, that means that medium-term rates are falling relative to short and long-term rates. So we're going to do just the opposite. We're going to buy a medium-term bullet and short sell a barbell. Now look at the bottom diamond point down there. Butterfly strategies are not convexity neutral. Go ahead, repeat that sentence. Butterfly strategies are not convexity neutral. That sounds like an awfully cool question to ask on the exam. Now remember, what the Institute is going to do in this question stem, they're going to have a client or they're going to have an analyst, and there's going to be somebody, let's say his name's Jeff, and Jeff makes the following observations. This sounds like a great observation. And the question says, do you agree or disagree with Jeff? Butterfly strategies are not convexity neutral, as barbell has a higher convexity than a bullet. That was on a previous slide, so that makes perfect sense. How about if we address this volatility issue in the LOS? Now, you remember back in a recording, we had part 1 and part 2 just recently in this series of readings, and I was telling you about a callable bond. We didn't show you this picture because I knew we were going to do it in this slide deck. So here's a picture of an option-free bond. There's the relationship. It's not linear, of course. It's not linear at all. But when you have a call feature, that convexity, which is all positive for the option-free bond, that convexity turns negative at lower interest rates. And the reason that it turns negative at lower interest rates is because the bond price is going to be capped at $1,000, right? You'd have to be pretty shallow and pretty ignorant to go ahead and pay $1,200 for a callable bond that's about to be called tomorrow, and all you're going to get is $1,000 from that bond. All right, so what is a yield curve strategy here? So what happens when we own a callable bond when the yield to maturity declines? Then we're going to, remember this is what I said earlier, we're going to get cheated because we're not going to get the 1,200. We're only going to get the negative. We're only get the par value of $1,000. All right, so look at that third teardrop point. At low yields, callable bonds have negative convexity. That's exactly what I was talking there. There's the arrow coming up from the word callable bond all the way to that curve. Now, what this means is that the price of that bond is driven by the value of that callable bond. All right, so keep that in mind. Let's switch over to a puttable bond. There's the dotted line over there. What's a puttable bond? That's just the opposite. Is the right but not the obligation to sell the bonds back to the issuer when interest rates increase. What happens when rates are increasing? What happens to the price of our bond? The price of our bond is falling, right? 900 and 800 and 700. But if it has a put feature, we can put the bond back to the issuer and force the issuer to sell us that bond. To buy back that bond for $1,000. So the value of that put option is tremendously higher when those yields are high. Let's see, those teardrop points, I think I said that. Yeah, put option increases. Yeah, flatter slope. Oh, yeah, that's important. Notice that what happens, we got that downward slope, and then it goes over to parallel to the horizontal axis because of the $1,000. So let's go back to the LOS and try to formulate this, right? So when the yield curve shifts upward, that callable bond will fall by way less than an option-free bond. How about the puttable bond? The puttable bond will fall less than the option-free bond as well. So these embedded options, buying bonds with embedded options, are part of this Formulate a portfolio positioning strategy. So what do we want to do? If we think interest rates are going to rise, then we go ahead and buy the callable bond because we'll just get the regular payments and we'll pay less for that bond today. If we think interest rates are going to rise, we can buy the puttable bond because if the bond, if the yields go up high enough, we can go ahead and exercise our option. Remember, the call feature is owned by the issuer. The put feature is owned by the bondholder. Now, we need to go ahead and remind ourselves that when we have bonds with embedded options, we can't use our regular old Macaulay duration. We can't modify it to come up with a modified duration, and the same applies with convexity. So what we need to do is we need to compute the effective duration and the effective convexity, because those two measures, and remember, they're still first and second derivatives, they're going to reflect the uncertainty of those cash flows when that embedded option is exercised. So look at the second diamond point. This is super important. The option in the embedded options always lowers the duration of a comparable option-free bond because the call feature, the put feature might be exercised so that even if it's a 30-year bond, those two options might be exercised after, 3 years or 5 years or 7 years. So clearly it's not a 30-year bond. It's only a 7-year or a 5-year bond. So what do? We can change the duration and convexity of a fixed income portfolio using those embedded options, or we can go ahead and explicitly add derivatives to the portfolio. All right, so what about that adding a derivative? So if we add a call option on top of a bond price, that increases the duration and convexity of a portfolio, right? And that's going to decrease the duration and convexity of a fixed income portfolio if we add put options to the bond. Now, if we add a swap contract, or in this case, an option on that swap contract, well, it depends on which way we're paying. If we pay fixed and receive floating, what that does is that decreases the portfolio duration, because remember, floating rate bonds have very low duration and convexity. So let me say that again. There's that second bullet point. When we pay the fixed and we receive the float. Now this is an option, so we're buying an option, so we have to pay for it today. We're going to buy the right but not the obligation to enter into a pay fixed and a receive floating. What that's going to do is that's going to decrease the portfolio duration. If we buy an option to enter a receive fixed and pay floating, that increases the portfolio duration. And remember, valuable as interest rates rise, valuable as interest rates fall for those two types. All right, what about this concept of, we have our yield curve and we've done this, right? Parallel shift. We've done this, parallel shift downward. We've done steepening and we've done flattening. But what happens if we ask ourselves the question, we have this yield curve and I'm super sensitive to year 11. I'm super sensitive to year 11. What happens if the 11-year, I'm going to go ahead and call it a spot rate. I'm not sure that's exactly and technically true. But what happens if the yield to maturity or the spot rate on a zero coupon bond at year 11, what happens if that thing changes? What happens to the duration? What happens to the price of our bond? That's key rate duration. Measures the sensitivity of a portfolio over a set of key rates. So you can have a key rate at 3 and 5 and 10 and 12. In my example, we just had one key rate duration. Effective duration is just the sum of all of those key rate durations, which is what I was just saying. There's a good old equation there. You probably saw this back in level 2, but I want to add a couple of my editorials here onto key rate duration. If you're looking at this yield curve, it's not really all that intuitive to say, what happens if the yield at, what did I say earlier, 11 years, what happens if that just, for some crazy reason, everything else stays the same on the yield curve, but at year 11, that rate bumps up by 50 basis points or 100 basis points. And I really can't give you quite an intuitive response to that question, but the intuition revolves around, look at that second bullet point, the sum of all the key rate durations. If you have key rate durations at each key rate, you might have a client who wants to buy a motorcycle in 6 months. You may have a client who wants to build a house in 3 years. You may have a client who wants to send his or her children to college in 7 years. You may have a client who wants to retire. One of the clients will want to retire in 11 years. One wants to retire in 17. So you have all of these key rates. So the key rate duration concept makes less sense at the individual key rates, but much more sense if you look at it in its entirety. So uses of key rate durations measures bond sensitivity to changes in the shape of the yield curve at those key rates. But what it does, it provides tremendously useful information regarding the exposure. So what if some crazy happens that when we want to, what did I say, buy a motorcycle, buy a beach house, send our children to college, what else did I say? Whatever, retire and do whatever, travel to Italy or whatever it is. What happens if at each of those key rates, those yields move against us and our portfolio falls at those key rates? Then we say something like, okay, to our children, you can't go to college, we can't have a beach house, we can't go to Italy. So this gives us tremendous information to identify that shaping risk, but also then to manage it with derivative securities or all those things that we have just talked about. Now let's go ahead and work through an example of key rate duration. So down the left-hand side, there is the maturity date or the tenor of our portfolio. We've got a 2, 5, and 20-year bonds in there. There's the active key rate duration, 0.22, minus 0.48, 5.29. So our portfolio then is 503. Compare that to the index of 2.88, and there's a difference of 2.15. All right, so here we go. We're trying to decide 2, 5, and 20 years whether our actively managed bond portfolio is going to under or overperform the index. We're going to highlight those differences over there on the right-hand side. Now, one quick thing. Notice that there's a key rate duration that's negative. That probably is counterintuitive. What do we know? When yields go up, bond prices fall. But a key rate duration right there of a minus 0.48, that tells us that if yields go up, bond prices go up. And that can happen, I should say, at unique parts of the spectrum along the yield curve as we're looking at key rates because of perhaps differences in maybe coupon rates inside of those 5-year bonds. Maybe it has a super low coupon rate, and that super low coupon rate then turns it negative. So don't think that that the Institute has just turned everything that we've learned upside down, but this is just kind of specific examples where yields go up and bond prices might go up. All right, so how do we analyze this? So keep this in mind here. How do we analyze this table? So we have negative differences. So what is that telling us? At the 2 and 5-year maturities, the active portfolio has lower exposure to short-term rates. Everybody see that? They have lower exposure to short-term rates than the index portfolio. But that large difference means that the active portfolio has a far greater exposure, right? 3.76 versus the 19 and the 142. Remember those 19 and 142, those are negative numbers there. So what are we saying? Let me just repeat that. Look at the 2 diamond points. Active portfolio, lower exposure to short-term rates. Active portfolio, far greater exposure to the 20-year rates. All right, so that's what we're doing right now, but look at the very bottom diamond point. If the manager used only derivatives to create the active portfolio, all right, so if we wanted to substitute, if we wanted to synthetically replicate this table, what could we do? We could receive a fixed 20-year swap, pay a fixed 2-year swap, and short a 5-year futures contract. And so this little pie chart over here summarizes the layering of derivatives that we've talked about in all of these slides. Now let's go ahead and finish up here with currencies. And I think we did a recent recording on currency risk management. And this is really stuff that we've recently learned. There are 2 equations for single assets. So we're going to take 1 plus that return on the foreign currency and 1 plus the return on the foreign currency, the foreign exchange rate. And these are compounding, so that's why we have to do the 1 plus. This is really nothing more than an F over P minus 1, except the F over P is done in terms of multiplicative of the currency returns and the exchange. And you can do this with the portfolio too. Notice you just put a little W out there. Now, how do we formulate this positioning strategy? That's not really what the LOS asks us here, but essentially what it's doing. And we need to go back to our economics days when we talked about covered interest rate parity. What does covered mean? That means that we take, let me give you the example that I did. This was a couple of recordings ago. I have $100 US and I want to invest in a Canadian bond. Let's suppose the exchange rate is unitary. So I exchange my $100 US for 100 Canadian dollars. I buy a 100 Canadian dollar bond. And let's suppose that that matures in 1 year for 110. So all I do is I enter a forward contract to sell those 110 Canadian dollars back to US dollars, and hopefully I'll get, something more than 100 US dollars, right? That would be a negative return. Maybe I'll get 106, maybe I'll get 108, maybe I'll get 112. It depends on what the forward rate of interest is. So look at in the purple box, the third bullet point. It ensures that the return on a hedged, all right, so this is a hedged position because we have the forward contract, that hedged foreign risk-free investment is the same as whatever it was here in the United States. So when I said maybe we'll get 106 or 108 or maybe even 112, well, it depends on what the risk-free rate of interest is in the United States. If it's 6%, then we'll convert back to 106. If it's 12%, we'll convert back to 112. Now, of course, the uncovered interest rate parity condition is true and holds. All we're going to do is the exact same thing, but we're not going to layer it with a forward contract, the uncovered portion there. And so what happens then is all we can say with uncovered interest rate parity is that unhedged, right? We're not using a forward contract, so it's unhedged. We're going to take our 100, transfer it into 100 Canadian dollars. We'll have 110. So we're not hedging, so we'll get whatever that change in the currency is. We'll get that future spot rate of exchange. Now, there's probably a forward rate bias in there because investors in low interest rate countries are borrowing and they're converting to high interest rate economies and they're investing. And so there's probably a forward rate bias in there. Now, how about some active cross-currency strategies? We've talked about swaps all along, so what we can do is we can do a receive fixed and pay fixed. So watch this. I'm going to go to the next slide. So we have 4 of these here. So we're going to start with the simplest. We're going to receive a fixed and we're going to pay a fixed. And this is really just a matter of we want to borrow in the lower currency and invest in the higher currency. And so this is called a carry yield. So that's just the higher yield and the lower yield. So this is an active cross-currency strategy. And I'll pause on my editorial here until we're done these 4 different strategies. So if we receive fixed and pay fixed, then we can receive floating and pay floating, right? We're going to do the same thing, but we're going to borrow with a floating rate and we're going to invest in a floating rate. And so that yield, this is going to be an unhedged return. It's going to be the carry, the difference between the 2 yields like we just had above in the receive fixed and the pay fixed. But then we're going to have a difference between those interest rate differentials for that lower yielding currency because we're going to borrow in the lower one and then we're going to have to repay somewhere down the line. Now let's start with the receive floating and pay fixed. Well, what's going to happen here is we're going to do the carry and then we're going to have that higher floating yield minus the lower fixed yield, right? So that makes sense. This is going to work if that floating yield remains higher than the fixed yield. And then the same and opposite is true for receive floating and pay the floating. So these are interesting kinds of scenarios here under which, what's that LOS say? Discuss yield curve strategies. So it really depends on the relative interest rates between the 2 countries' economies. Not only the fixed rate of interest, but the floating rate interest. So you got 2 sets of interest rates on each country. So that's a total of 4 interest rates that you need to manage. And so just remember that, you want to borrow in the lower currency and you want to invest in the higher currency, assets in the higher currency. And of course, hopefully that will pay off in the end. But this is what my editorial I mentioned just a few moments ago. You try to wrap this around your brain and you say, okay, I'm going to do this. I'm going to borrow at 5% and I'm going to invest at 10%. That ought to work out every time. Should be an arbitrage opportunity, but it doesn't work that way because there are lots and lots of people out here who are trying to do the same thing. And there are spot rates and there are forward rates. And there are inflation rates, and there are central banks, and there are, I could list a whole bunch of other things that are probably going to get in the way. That's why the Institute wants us to know everything about the U.S. macroeconomy and the Canadian macroeconomy before we execute one of these yield curve strategies across the currency. right, so I promised you in the beginning of this slide that we were going to come back to this particular equation. There it is. Now, what we're doing here all we're doing is adding that, what is that, the fifth one, the investor's view of the currency value changes. And so we need to have multiple assumptions about the market changes because, I mean, let's face it, if we have, in my simple example, just Canadian bonds, what did I say? We need to worry about not just 4 different interest rates, but 2 different inflation rates, right? 2 different central banks. And then if we have Japanese bonds, if we have bonds issued by Ireland and England and Spain governments, then we've got all of these kinds of things that are wrapping together. Now, of course, if you're really smart, and I know many of you are, what you could do is you could have one of your portfolio over here and one of your portfolio over here, your international portfolio, and those currency values could offset each other with correlation coefficients of a -1. I'm not smart enough to figure that out, but I bet many of you guys can do this. All right, so let's finish up with an example. A bullet versus a barbell portfolio. So we have a 1-year period, and really we just decided to do 1 year to make life simple. The examples in the reading go to much longer time periods. I'm not sure they really add any value to it. Average bond price, there we go. They're both around 56. Expected bond prices in a year, so that's probably around the same number. Portfolio duration, effective duration, and convexity. There you go. They're similar numbers, right? Except for the convexity, right? The barbell, we learned this earlier, the barbell has to have higher convexity. Expected change in yields and change in the currency. So there we have 0.5% and a 20% depreciation. So solve for the expected return over the 1-year investment horizon for each portfolio. All right, so let's do this. These are 0 coupon bonds, so there's no coupon income. That makes life a lot simpler. Here's our roll down return. We just take the difference between those two. Here's again F over P minus 1. So don't be upset because remember this is just 1 year. So these yields are, these roll down returns are going to be super close together. So 2,113 and 2,109. How about we use those really cool formulas from the very beginning of this slide deck for the investor's view of the benchmark yield. So there we're just going to compute the bullet and the barbell. We just substitute the difference. Remember, the only difference here is going to be the convexity. And so what do we get? 1429 and 1418. Let's see. We're going to just do something super simple here, no information about the spread, but you could go ahead and use that equation and do the mathematics of a change in the yield spread. You could do that pretty quickly. And then here's our impact of the currency. We're just going to go ahead and do the same formula that we had before, and there's our 0.2% depreciation, so we get 483 and 493. So what do we say? The barbell outperforms, probably from the convexity. And I think that takes us through all of these learning outcomes. This was relatively long reading, and I kept you for a little bit longer than I normally like to. But I want you to go to the, I can't remember exactly, are there 31 or 29? And all of these are in the multiple choice format at the end of this reading. But I want you to go through those, and I want you to do something different than what we've done, my recommendation in the past. What I want you to do is I want you to go through these 30-odd questions. I want you to go through them as quickly as you can. I want you to read the question stem and then just look at the answers and just check off like what you think it is, based on the generalities that we talked about here. And then I want you, and you could do that in probably just a handful of minutes. Then I want you to go back and I want you to read the questions carefully because the Institute emphasizes almost every one of these LOSs equally. So thanks for watching. Hey, good luck studying. Have a great day. And the last thing that I want you to see before you relax is my smile. That's my smile from one of the Terminator movies, Arnold Schwarzenegger. So anyway, have a great day. See you soon.